Good morning, welcome to the Market View for Friday, the 1st of August 2014. And starting off with the British Pound, we can see that we had a sell signal for yesterday morning, just after 8:30 there, and we can see prices then moving lower. However, it took a moment or two for the market to actually trade down to the 20 pip scalp, and once we'd got down to this level, we can see that we had some support coming into the market at the S1 level there, and then eventually the market breaking through and continuing to move lower. Now, trailing the stop on this trade, which we will use 100%, the market's traded down to the scalp target, and then we see the support coming in. Here we have an inside bar. When you get an inside bar, it is better to use 100% to trail the stop as opposed to 50% because the range is so narrow and inside of the previous bar. This allows the market then to make up its mind on whether it's going to move back to the upside or remain sideways for the duration, or to then move lower. So here we see the market moving lower and continuing with 100% below, sorry, in this case above the green bar. You can see we end up back at the scalp. So of course in this particular trade, you'd think, well, after all of the last few hours of staying in, I end up back with a 20 pip scalp. But of course, if the market had continued low, it would have been a different story. So it's a balancing act of trying to decide whether you want to stay in there for the longer term and take more out of the trade, or actually taking profits off the table at the scalp level. The maximum amount of profit available on the trade from the entry point down to the recent low here was 41 pips. So it is double the scalp at this point, but of course, unless you're psychic, then you're not going to know that that is the bottom. However, you could consider adjusting from 50%, from 100% to 50%, and this would increase the number of pips available. But again, not a whole lot compared to trading down to the 41 pips. However, that said, given the last few weeks of how quiet the market has been, I'm happy to have a 20 pip profit, or just 23, 24 pips, than having no trade, or worse still, a losing trade. So at the moment it's a case of grateful for small mercies at the markets. Well, in particular the pound is like it is at the moment. So on the daily chart, again, another red day. We've just got this continuing red. We've got red again this morning. We can see this as well. And let's just have a look and see what yesterday's low was, and just move across to the left hand side. You can see the market came through the 168.50 area in its recent up move through June, and then July has been sort of up the mountain and down the other side there. So the market looking for support at 168.50 there for the pound at the moment. So we can remove these two lines and see how the market holds at this level. Let's just draw in a few fibs. If we go from this recent low to the recent high, you'll see that the market's trading at 62% from the June. There we go, from the June low. Is that the June or is that May? Actually, it looks like May. Yeah, May the 29th to the July high of 15. You can see there the market then retracing down to 62% of the move. If you wanted to find out why the market's trading at this area, you could actually use what I call the rolling fib. And what you do is you just look across to the left, take the next low, which would be this one, up to the recent high, and there you see 76%. You will always find the market around a 76%, or the low of that day, a 76%, based upon the daily chart. And looking back there to the recent low to the left, and then if this one's taken out, we move to this one. If this one's taken out at 76, then this one, and so on, until we reach the main pivot areas, or the main swings in the market there. So let's have a look at the Dow. A big day on the Dow yesterday. The Dow dropping down 317 points. And here you can see the market trading down towards the 76%, something I've been going on about for weeks from the original implied volatility video that we're likely to see a correction in the market. It looks like this is now definitely underway. And we can see this also from the high and also the low on the same bar where we struggled with the 76% here. And no doubt, if we have a look at the rolling fib situation, you've got 76% struggling there. So the downside pressure is certainly on for this market at the moment. Expect this to be a lot of selling. Of course, the GDP figure of 4%. Actually, this is where the Fed shoot themselves in the foot with manipulating the figures, because if the forecast is 4%, of course, they're going to have to consider increasing interest rates, which puts downside pressure on the market, and also curb the monopoly money that they've been printing for the last 5 years. And of course, once that goes out of the market, then the market has no other choice except to have its bubble deflated, which is what we're seeing at the moment. So any rally at this point to the upside is going to invite a potential short trade. In the implied volatility, this sprang to life yesterday, 13.43, coming off the low of 7.9 on the 3rd of July. So we're looking around 15%, 16% for 100% increase in this. Well, actually 16% or more would be great to find a potential bottom in this correction. So 100% increase in the implied volatility. If you've not seen the video, then go and have a look on YouTube, and also in the membership part of the site under the training tab, where you'll find the video about how to read the implied volatility for finding the bottom of a market. So if you've not seen it, go and have a look. So the implied moving higher, and again, just keep an eye out for the sort of 16% there. The market's finding support on the overnight is actually back up, so we may see a bit of an up move during the early hour session and the pre-market session, but any sort of rally on an intraday basis should offer a potential short there. Right, well, that's it from me. All things being equal, see you on Monday. Have a great weekend. As ever, thank you for your support. Very much appreciated. And as ever, thanks for watching.